Assalamu alaikum. Hello, everyone. Good evening. How are you doing? Hi. Good evening, Jaya. I'm perfectly well, Tasi. Perfectly well. Hi, Hamza. Okay, Hamza. But I was aware about the screen sharing now, so bit cautious. Let me know if any of you have any troubles with last lecture. If something you couldn't understand with the in the previous question. Hi, Sabina. Okay, so today we are going to start practicing question number 2 of section A. Hi Amna, I'm perfectly well, yes, quite well. Hope you're all sure I want to show you myself. Yes, Sabina, it's just add some more calculations like in SBR. Will not. I am trying to not be getting that much calculations part, but because practicing theoretical area only will be quite boring for you people, so I've just added some interesting calculations so that you can remain active with me. Oh, I'm there. Fair, very close to this, the questions I have set, but the calculations part in your actual SBI exam would be lesser than this. Avinash, like has the exams been cancelled in Sri Lanka? Aren't you getting those remote invigilation option even? I hope things are under control over there in Sri Lanka. Cindy can't hear me. Update. So you have got the remote option. You can go for it if you have planned it well, and you are quite ready for your SBR attempt in June 21. Then I would suggest you don't miss it. And if you have got good machine, good laptop, a bigger screen, you can be comfortable at home. Sure, Ola, we can. Question raised by Ola is right. Oh, wish you good luck. It's quite risky. Stay safe, Avinash. It's third wave over there in Sri Lanka. We are also going through the third wave, and it's quite dangerous. Ola is asking me to go through some uh, items that will be reported to other comprehensive exam, other comprehensive income, right? Okay. Uh, this is not part of my plan, but Avinash, we don't trust our internet, we don't trust our devices, and we don't even trust our family. They can enter my room anytime. Okay, so the question raised by Ola is what are the items that will be reported to other comprehensive income? What do you people believe when we prepare the statement of profit or loss? Sure, Ola. So it's no more just a statement of profit or loss, but it's now bit lengthy statement of profit or loss and other comprehensive income, right? We are clear about the items that are taken to profit or loss. Can you people tell me what items are reported in other comprehensive income? Anyone? What items are reported in other comprehensive income? Are there any general statements? General statements. Rohan says items that are different from business model. Okay. Sam, as an example, revaluation surplus is right. Jaya, as an example, IFRS 9 is right. Can we say something generally? So can the answer can our answer be general, or would there be a specific list? Very nice, Pures. Remeasurement of IS 19. Remember, what is misconception about this? Amna, we are asking, like, we are discussing what reported in other comprehensive income. Foreign exchange differences, William, right? Can we define it generally so that one can understand by himself or herself that what items shall be reported to other comprehensive income? Sam, this is wrong. So Rohan's statement is wrong. No, Dhwani. No, Samad. Remember, there can not be any general definition for this. It is rather a specific list. So you cannot decide or define what goes into the comprehensive income generally. This has a list of items that are defined by the regulatory framework, right? As a general, I could explain that incomes or expenses that do that directly affect equity of business other than contributions by or distributions to equity holders. Fair? Generally, I can define it this way. No, Hamza, there is no conceptual framework for this. What goes into other comprehensive income is not generally defined by IFRS. It's not generally defined by a conceptual framework. Sorry. As a general definition, I can define in my wordings that any income or expense or any gains or losses that directly affect equity of business other than contributions by or distributions to shareholders. So we have got some examples. You might recall that when you were not grown enough, when you were a child, Uh, we teachers used to tell you something about revenue expenditure and capital expenditure. As a general principle, we remember that any expenditure that enhances the capacity of an asset or increases the expected benefits from an asset are capital expenditures, and those anchored to maintain the working capacity of an asset are revenue expenditure. But this is what the conceptual framework says. Majority of items to be treated as capital expenditure or revenue expenditure are not subjective. Majority of items have already been defined by standards that what should be capitalized into the cost of the asset and what cannot be, right? So what goes to other comprehensive income is not part of subjective judgment. What is common misunderstanding? Students believe any income or expense that is unrealized is taken to OCI, but this is wrong, right? There is a specific list provided by the regulatory framework. If we talk about IAS 16, what goes into revaluation, like other comprehensive income? Revaluation gain for the year or reversal of revaluation surplus. There is no concept and judgment behind this. This is something defined by IAS 16 explicitly, that as per IAS 16 and IAS 38. Remember, the revaluation gains of assets are taken to other comprehensive income and credited under equity under the heading of revaluation surplus. And if any asset faces downward revaluation but has a surplus in pocket, then the surplus must be reversed first and then the loss is charged to profit or loss. What else goes to other comprehensive income? You do remember IAS 12 says deferred tax related to items that are reported to other comprehensive income is charged to other comprehensive income. Do you remember this? So deferred tax also is charged to other comprehensive income. You do remember, if the taxable temporary difference arises because of revaluation, because the revaluation itself is taken to other comprehensive income, its corresponding deferred tax is also taken to other comprehensive income. What else is charged to other comprehensive income? As per IFRS 9, are classified as fair value through other comprehensive income, FETOCI. What else? As per IS 19, remeasurement gains or losses, which in past were referred as actuarial gains or losses, are taken to other comprehensive income. What else? What else do you think is taken to other comprehensive income? Anyone? That's it? Yes, good, Sam. As per IAS 21, exchange gains and losses on translation of foreign subsidiary and goodwill are taken to OCI. Yes, good, Tiffany. Yes. Uh, as per IAS 19, asset ceiling. Asset ceiling adjustments are also taken to other comprehensive income. Good. As per IFRS 9, effective movements of cash flow hedge. Doing well. Yes, you do remember. So, Ola, to your question, there are no general principles for determining whether something is supposed to be reported to OCI or profit or loss. You cannot judge it yourself. Anything that is allowed or required by the standard can only be taken to other comprehensive income. Now, there is another adjustment for this. We say other comprehensive income has two parts: items that may be reclassified and items that may not be reclassified. This is also specified by the standard. What IAS 16 has to say, that when asset is disposed of and its revaluation surplus is still present in equity, when an asset is disposed of and its revaluation surplus is preserved in equity, can we take that to profit or loss? No, that can be transferred from equity to equity, right? Yes, good, Sakib. That is directly taken to retained earnings or can be left there under the heading revaluation surplus. It is not necessary to transfer it. Fair. But to retained earnings, Amna, there is a difference between what is taken to profit and loss and what is taken to retained earnings. So when I ask the reclassification mean recycled to or recycled from profit or loss, can you show the revaluation surplus as income for the year? If you dispose of an asset in 2021 and the asset has a revaluation surplus, can you recycle that revaluation surplus to profit or loss for 2021? No, of course we cannot. So retained earning is different from profit or loss, of course. Yes, correct. So you'll be debiting revaluation surplus and crediting retained earnings. What happens in case of FET OCI? Which instruments can be taken to FET OCI? Can we carry date instruments at FET OCI? Both, yes. When can we take date instruments to FET OCI? Jaya, can we report date instruments at FET OCI? We can. Can we report equity instruments at FET OCI? Yes, we can. When can date instrument be classified as FET OCI? If not held for trading meets cash flow characteristics test and company's business model is achieved by holding some and selling some debt instruments, right? Jaya, if any instrument fails the test, will definitely be taken to FETPL, right? No, Sam, there is no election option for debt instruments. There is no election option for debt instruments. Dhwani, we cannot make declaration in case of debt instruments. There are certain criteria. Yes, correct, Amna. For equity instruments, an irrevocable election is made at initial recognition, provided equity instruments are not held for trading, right? What are the differences between debt instruments FVT-OCI and equity instruments FVT-OCI? Remember that in case of debt instruments FVT-OCI, amortization at effective rate continues and must be charged every year. Any fair value gains and losses are taken to OCI. What happens in the end if, yes, Sakib, dates can be traded. There are two types of date, marketable and non-marketable. If I invest in saving account of a bank, that is a particular dealing between me and bank. That is a specific contract between me and the bank. This cannot be traded. If I have sold goods to a customer on credit, the customer is supposed to remit me the cash. It is contract between me and the receivable. This cannot be traded on exchange. But the bonds, loan notes, debentures, convertibles, such dates can be traded on exchange. You can sell the bonds you hold in the secondary market, can't you? So if that date is specific, and a specific agreement between the company and the lender or the loan provider or the customer, then this cannot be traded. But the bonds issued to general public are traded on exchange. What happens next? If a company if a company disposes of bonds held which were classified as FVT-OCI before maturity, if a company sells bonds recorded at FVT-OCI before maturity, what happens to the gain or loss recorded in equity reserve? No, Sarmad. This FVTOCI is not revaluation. The question raised by Sarmad is that if we record gain in equity and in case of loss, are we supposed to reverse equity first and then debit profit or loss? Remember, FVTOCI, gains or losses both are taken to equity. Equity may go negative, not a big deal. Equity items are items in the statement of financial position that may also go negative. You must have noticed that retained earnings are not always earnings. At times, for few companies, the retained earnings are rather retained losses and are reported as a negative balance. Daniel, I'm correcting you. If company had bonds recorded at FVTOCI and company decides to sell the bonds before maturity, any gains or losses held in equity are reclassified to profit or loss. Uh, Ola, your question is, I'm simplifying your question. Is there any difference between OCI and OCE? If I ask you, is there any difference between profit and retained earnings? Yes, Jaya. It's not can, you have to. If company disposes of debt instruments recorded at FVTOCI before maturity, any gains or losses in equity reserve are recycled and reclassified to profit or loss. Good. Hamza, you say profit are for the current year and retained earnings is accumulated. Very nice. Sakib, same here. OCI is for the year and other components of equity are accumulated reserves. So Ola, you said that OCI is other side of equity or equity is other side of coin of OCI. No, there is difference. OCI is performance. OCI is what? Performance. And OCE or equity is position. Sam, interestingly, what happens? The question raised by Sam is, if we hold FVT OCI until maturity, Naledi is facing some connection issues. Are you people also facing any troubles? If yes, I must turn the webcam off. That's all right. Sam, what happens when? Okay. So all others are well with the connection. There might be some issue at your end, Naledi. Fair. We are moving forward. When we carry date instruments at FET OCI, just have a look. How does this work? We continue amortizing FVT OCI instruments. So how's the format? Brought down balance plus finance cost at effective rate. This continues. Less coupon rate equal to CD balance. Fair value gain or loss. Revised CD. This is how we carry debt instruments at FVT OCI. Until maturity, fair value of debt instrument and redemption value will always be same. Note this point. At the date of maturity, the fair value of debt instrument and redemption value of the debt instrument will always be same. Any equity reserves of FVT OCI will automatically reverse over maturity period. Since there would be no equity reserves in the end, reclassification is not required. But for equity instruments, last point, but for equity instruments, any FVT OCI gains or losses in equity are not reclassified. Note it. Fair. Let's see the question now. Start practicing with me, right? Your calculators must be active. Your brain must be active. Yes, Amna. For debt instruments, any equity reserves are supposed to be transferred to profit or loss. But if we dispose before maturity, you can only get equity reserves if you dispose before maturity. If you hold till maturity, there would be no gains and losses left behind. No issues. Thanks, Ola. Net stock, a hero. Net stock. Sarita, let me see if I can in the handout section, because this is normally what's done by the team. I cannot see the option here to upload it. Well, I've sent it on the WhatsApp. Sure, Pooja. Let me alter it so that you can take the screenshot. Rest in peace, Nate Stark. Yes, Ved. Yes, of course, Ola, I can. I'll share this question on WhatsApp again. Shall we move, Pooja? Are you done with the screenshot? This one as well? Okay, so I'm freezing my screen for a while and sending you on WhatsApp. I just need 1 to 2 minutes. Please wait. It's very difficult to manage the screen. Where did the file go? Okay, I think I need to close it for a while. There you go. I've shared on WhatsApp. You can check it, please. Shall we start now? Zayan, was this enough? Or do you still need the screen? If Pooja has taken the screenshot, can you please share on WhatsApp? Okay, explanation. Which area, Zayan? You can ask. Date instruments, sure. Zayan, when we have got date instruments, the bonds, loan notes, debentures, or anything we have acquired of another company, they always have a maturity, of course, because these are the date instruments. These can only be date if they have a maturity. So if you are carrying those date instruments at FET OCI, you are supposed to continue amortizing it. Remember, you are not supposed to get exemption from amortization. This part would continue. And in the end, the fair value and the redemption value would definitely tie. Any gains or losses in equity against those date instruments are taken to profit or loss, provided you dispose of the bonds or loan notes or debentures before maturity. Moji, this one that I have recorded as notes. Fair. So let me keep it saved. I'll continue typing on this for further explanations, and I'll share in the end. I'm not deleting it. Let's move to question now. All right. So net stock is an ACCA member. Like you can say was an ACCA member, but fair is an ACCA member and employed as financial manager of North Limited, King in the North. He recently returned after a long medical leave and has been provided with draft financial statements of North Limited for year ended 31st March 2021. Right? Following figures are reflected in draft financial statements. The profit before tax is $125 million. Total assets are $1420 million, and total liabilities are $925 million. While reviewing, no, he's not Iron Man. Who is Tony Stark? Fair. So while reviewing the financial statements, Nate noted, oh, okay, I'm unaware. Nate noted that following issues are issues in the exhibits. So we have got 4 exhibits. Number 1, inventory valuation, which is carried at cost. You do remember IAS 2. Inventory must always be recorded at, yes, the common sentence. 2, subsidized interest loan from government. What does subsidized mean? Below market. So the government has provided us a loan at an interest rate that is lesser than market rate. Makes sense, Hassan. IS 20 might apply. 3, sale and leaseback transaction. Sorry, it's not leaseback. Sale and buyback transaction of plant. And 4, ethical concerns and threats for the net stock. Hand of the king. This information should be used to answer the question requirements within the response options provided. Mostly for SBR, like you people have been asking that shall we use word processing for theory, or shall we use a spreadsheet for the theory? For each exhibit, a separate requirement would apply, and you will only be getting one option, mostly, except for question number 1, mostly. So if you have got both options, you can choose the one you want. Exhibit number 1, I have filled it with calculations just to keep it very interesting, and this will give us a good revision of some standards. Details of 2 of North Limited's products, which are carried at what? Historical cost. As on 31st March 2021 as under. So at year end, we are carrying 2 products in inventory at cost. Product A and product B. Let's concentrate on product A first. We already have 5,000 units available of product A in inventory. Historical cost, we bought these units at 10,000 rupees dollars per unit. Now the estimated selling price of product A is 9,700, and estimated cost to sell is $300. What does current replacement cost mean? Anyone? What does current replacement cost mean? And what do you mean by to replace inventory, Hamza? It's not fair value actually. Fair value is the price that would be received to sell an asset. The current purchase cost, like if we wish to purchase the inventory now, yes, good, Hassan, nice. So if we purchase inventory now, How much would this cost us today? Do we have to do something with that? Fair. How many number of units we own? We have already 5,000 units in hand. We had purchased. Amna, replacement cost is the value at which you can purchase new inventory. The value at which we can purchase inventory today. If you want to buy. Current value is confusing. Current cost or current value has two possible valuations. One is realizable and the other is replacement. Realizable means at what value can you sell it? Yes, coming over that, Ola. What is fair value? Is it an exit price or entry price? What is fair value? Is it an exit price or entry price? Of course, exit price. So fair value is the price at which or that would be received to sell an asset, right? To sell an asset. So replacement cost is different from correct replacement and fair value. Zayan, you're right. Entry value is replacement, the value at which we can buy new inventory. So what's the requirement? This is the first exhibit. Requirement is A, discuss the appropriate accounting treatment of above issues. Discuss the appropriate accounting treatment of above issues and show the impact on relevant assets, liabilities, and total assets to liability ratio of one, inventory valuations at year end. Clear about the requirement? Fair. Back to question now. How many number of units of product A do we hold? 5,000. Let's see what's the case. Let's start solving it. You can perform the calculations at your end as well. If you want to take a screenshot, you can take it. If you are accessing the WhatsApp group, you can use it from there. I would appreciate if you could also perform the calculations. Done. I'm moving towards answer now. But we are supposed to discuss. So we'll clarify that we are supposed to answer one A requirement, that is regarding the valuation. We'll start discussing about the relevant standard, International Accounting Standard 2. IS2, good. Sure, Hassan. I'll be sharing on Excel. So in ordinary course of business, inventory can be in three possible forms: raw material, work in progress, and finished goods. Any inventory purchased by the business is recorded initially at cost, but any unsold units of inventory at the year end must be valued at lower of cost and net realizable value. How would you define net realizable value? Yes, anyone? How would you define net realizable value? Sales price minus selling cost. Sales price minus selling cost. Zayan, you are correct. It is not just selling cost. While the net realizable value is estimated selling price less estimated cost of completion and cost of sale. If goods are in raw or WIP stage, cost of completing या cost of completion must also be considered when determining NRV. Hassan, SBR examinations are less interested with calculations. See what the question requires. The requirement of the question is to discuss, and this is the case with majority of SBR questions. You have to follow the command. If you are going to perform calculations only without explaining the standard, the examiner will not grant you marks. And the reason behind this is that examiner wants us to learn how to read the standard. Sarita, if we are manufacturers, right? If we are manufacturers, so we do use absorption costing while valuing the inventory. Say you purchased raw material, you incur direct labor, you incur direct expenses, you are supposed to absorb the factory overheads, and that would be the cost of closing stock. Fair. In case of North Limited, yes, Dayan, your intention must be to sell it within 12 months. Entire accounting applies on intention, not on what actually happens. Your estimates might change, but if you have active intention to sell the inventory within 12 months, that would be an inventory. But if you fail to sell it within 12 months, that would still be classified as an inventory because your intention is still same. Yes, if you cannot sell, if the actual results differ from your expectations, the intention prevails. Accounting treatment depends on intention, not on actual events, right? But if you change your mind You have just quoted an example that the cars manufacturing company or an automobile company is not able to sell all cars within 12 months. Even if the company is not able to, the treatment will not change. But if the company changes its mind and starts using those cars, and company changes its intention to sell within 12 months, then an alternative costing accounting model would apply. But as far your intention is same, fair, as far your intention is same, the treatment depends on the intention. So in case of North Limited, both product A and product B are finished goods. So net realizable value will be determined by deducting estimated cost to sell from estimated selling price. Let's observe a twist. We are given historical cost, we are given estimated selling price, we are given estimated cost to sell, we are provided with current replacement cost. Further, the question mentions details of firm sale contracts. We have already committed to supply some units of product A and B. Out of 5,000 units we already have, we have committed to supply 3,000 units at a price of 9,800. Now, your call. What do you think should be used for calculation of NRV? Should I use the estimated selling price to calculate NRV, or should I use the contract price that I have already agreed? Daniel says estimate. Yes, Diane, how would you calculate NRV? Would you use the estimated selling price or contracted price? Sam says contract price. Jaya says estimated. So, mixed comments. Concluding, if company has already contracted or made firm commitment with any customer to supply goods or inventory at a specific price, then that contracted specific price must be considered first. Amna, it's not the current market price, but you have already booked its rate. So a customer has agreed with your company to make a purchase. So the company has an opportunity to realize this amount by selling it to that customer, of course. True, Ola. We have not yet sold. This is units to be sold. These are units to be sold, right? Okay. So if it is breached, if it's breached, but then you will have to face the penalty consequences, Ayan. Right? So you can see you can sell the inventory in market at 9,700, but this is good opportunity that you have contracted it at 9,800. Amna, Zayan was asking that if we are breaching the contract, then what happens? Then should this apply prospectively? So I was telling this that then the company will have to face some penalty consequences. Then IAS 37 might apply for the provisions. Correct, Tawfiq. So Tawfiq is suggesting that we should apply contracted price for 3,000 committed units. Very nice. And 2,000 which we have not committed at current price. Very nice. Correct, George. This would not apply to all 5,000 units. This can only apply to 3,000 units. Remaining 2,000 units are at risk. No, Hassan, no. Weighted average is not suitable here because you have absolute figures. Weighted average is normally used when you are making an estimate. You have got the absolute units here. Okay, so product A, performing calculations. I am dividing product A as committed sale and uncommitted sale. Let's talk about units first. How many units have you committed to sale of product A? 3,000. And we haven't committed anything for 2,000. Remainder. We'll use estimated selling price or the contract price. For the committed units, that is correct, Hassan. Your treatment is correct. Okay, so for the committed units, we are getting 9,800. 9,800. And for uncommitted units, I'm getting 9,700, right? Yes, Piyush, coming over this. Less cost to sale. In case of committed, how much is cost of sale? 200. And uncommitted, cost of sale is estimated to be 300. Net realizable value. You can copy and paste. The Excel would copy the formula, not the figure. Sorry, my mistake. Okay. Doing it again. If you copy the sale value, Control C, and you put here Control V, the Excel would copy the formula, not the figure. Since we cannot place borders in ACCA's spreadsheet, I am simply highlighting it by bolding it. And how much is cost? Historical cost at which we have purchased these goods are 10,000. How much would the impairment loss be? We are supposed to measure it at lower of, and NRV is lower in both these cases, right? Correct, Zayan. So for committed, we are exposed to loss of 400, and being prudent, we must record the loss immediately. So total loss. No, that is per unit, Ola. You can see it's dollars per unit. Sakib, state your confusion. Ola, clear on this? Good. Sakib, so 3,000 units multiplied by 400. Sakib, we have purchased all units at the same value. We have committed to sell it at different prices, but purchase cost is same. We have purchased all 5,000 units at same price, 10,000, but we are supposed to sell it at different rates. There is no difference between purchase cost, right? Fair. 3,000 units multiplied by 600. As I told earlier, you can copy the sale value. If I copy this, this will paste the formula. Note here. In spreadsheet, you can also practice this. But since I cannot place borders, so I'm better bolding it. Sakib, let me know if your confusion is unclear yet. Fair. So how much will the total loss be? There would be total loss of $2.4 million. Since the cost of inventory is higher than respective net realizable values, inventory must be measured at lower, right? So if we pass the double entry, what do you think will be debited and what do you think will be credited? If you have already recorded the inventory at cost, please state double entry. What would be debited and what would be credited? Credit inventory, Sam. Easy option. Debit profit or loss. Good. Good. Which item of profit or loss does inventory affect? It is not reported as impairment. It affects cost of sale. Correct. So we'll be debiting cost of sale and crediting inventory by 2.4 million. Sorry. By 2.4 million, right? Let's move to part B now. Product B, not part B, sorry. Product B. We have got 20,000 units in stock. This is a bit interesting. We have got 20,000 units in stock. We purchased for $1,500 each. Sam, it is good to perform double entry, right? It is better to perform double entry, because when you are convenient with performing double entries, that means you are convenient with the concepts. If you knew that inventory must be credited and you had no idea what should be debited, that is the only point where you would be afraid of double entry. But double entry pressurizes you to focus on both ends, debits and credits. Not a big deal, Jaya. You can write, but normally we do not refer impairment. You can, not a big deal. We can. Debiting impairment and credit inventory is fine. Product B. How many number of units do you have in stock? 20,000, right? You bought for 1,500. Fair. Its estimated general selling price is 1,700, and cost to make the sale is 100. Sorry. So how much is NRV? If we are free to sell, then the NRV is 1,600. But we are not free to sell, because we have made a firm commitment under which you must sell each unit of product B for 1,300. 1,300. No, Zayan, we have not contracted 20,000 units. We have contracted 28,000 units. But wait for a while. I'm coming at that point. Okay, good. So you made an alteration. The committed units are supposed to be sold for 1,300 rupees, dollars, and the estimated cost is $100. Which NRV will you be using for product B? 1,200 or 1,600? Hassan, well highlighted. Well highlighted. Perfect. Okay. So since we have committed, we'll be using 1,200 as NRV. Good. Everyone is going well. Hamza, nice. Wahab, Sam, Tawfiq, good. There we go. Let's perform calculations for product B here as well. And we have all committed. How many units have we committed? Let's focus on 28,000 first. Sorry, 20,000 units first, which we have in stock. Shall we use the estimated selling price? No. Shall we use the contracted price? That is how much? 1,300. Yes. And how much is cost to sale? In either case, 100. So how much would be NRV? 1,200. And at what value have you bought these goods at? 1,500. Which value is lower? Cost is 1,500 and NRV is 1,500. So cost minus NRV. Each unit is suffering a loss of $300. And how many number of units do we own? You can copy the formula. When you copy the sale, the Excel copies the formula. $6 million. So we can perform the complete entry altogether for product A and B. There is no need to separate it. You can observe I just corrected this, and since my double entry was integrated with this, so I simply added loss of product B as well, and the double entry changed from 2.4 to 8.4. Now the second interesting part, but North Limited has made a firm sale commitment for 28,000 units, out of which 20,000 units are already in stock, but remaining 8,000 units must be purchased at replacement cost and sold at an agreed lower rate. What term should I use for this? Hassan, I'm extending it for explanation, because as I said, this is not a genuine SBR question, but you can like be fair that this is not worth 4 marks. SBR would only be giving you product A in that case or product B in that case. I just wanted to keep the question bit lengthy. Very nice, Peter Bashir. Hamza, fair, we can use the term provision as well. Since cost of completing the contract is exceeding the benefits expected, then it is an onerous contract. Are you having issue with my voice? Anyone else except Ola? Any issue with my voice? Nobody is thing. Sound check, sound check. Yes, it's clear, crystal clear. Fine. Not yet, Amna. Not yet, Amna. Calculating loss now. Ola, voice is clear at everyone's end. Okay, since Amna, you can see here that we only have 20,000 units in stock, and we have promised to supply 28,000 units. Current replacement cost is 1,400. If you are supposed to purchase something for $1,400 and have contracted to sell it for $1,300, the benefit you are supposed to get is 1,300 minus 100, 1,200. And the cost you are supposed to incur for this is 1,400. Okay, so cost is exceeding the expected benefits. This is how I'm concluding this. Sure, Glory, onerous contract is nothing else. It is simply dealt with by IAS 37. Provisions, contingent liability, and contingent assets. If company has no realistic alternative but to settle any legal or constructive obligation, then a provision must be booked. So onerous contract is a contract whose cost of completing the contract exceeds the benefits expected from it. That is simply the term used for onerous contract. For your assistance, I'm mentioning here that onerous contract are loss-making contracts. Fair glory. Yes, correct, Filza. The onerous contracts are loss-making contracts. Since in this case, the company cannot avoid, we can perform the calculations over there. We have already made a table. Onerous. How many number of units are we supposed to supply? 8,000. At what price? 1,300. Estimated selling cost 100. But this would cost you $1,400 to purchase. Sakib, I don't know. Maybe the previous government. Okay, so this is cost or replacement cost. Replacement cost. At what value are we supposed to purchase it? 1,400. 1,400. And the expected losses 200 per unit. We can copy the formula or simply 8,000 units and $200 loss for each unit. But I'm not including this as an impairment loss because this is an onerous contract. So debit profit or loss by 1.6 million because the figure is in minus. So I'm putting minus in right after equal to make it positive, and credit provision for onerous contract. Very nice, Sam. Okay, Sakib, possibly if we could, but maybe it's a decision of time. He was correct at that time, but now the rates have increased. Fair. Easy with this? Next part. Shall we? Let me know if anyone is facing any confusion, please. Timely. Do not hesitate. Would not have been impaired. Yes, Catlico. Because if you have recorded inventory at historical cost and you expect more benefits by selling it, loss cannot be deferred and profit cannot be recorded earlier. Prudent, right? If you are expecting a loss, book it immediately. If you are expecting a profit, hold. Assets cannot be overstated. Liabilities cannot be understated. Next part. Chester, please explain your question. Go over it to the solution. Sam, if you plan to write lots of stuff, you'll be lost. Must spend some minutes, few minutes, immediately after reading the question. Must plan what are you going to write. You have got a scrap paper over there. Just make some notes that I'll talk about cost, I'll talk about NRV, I'll talk about firm commitments, fair, and I'll pass double entry. This is what you noted on the scrap paper. Take 1 to 2 minutes doing this, not a big deal. Because majority of students type and think simultaneously. That is a big problem. They get messed up. And when they raise their head up and look at the clock, they are very surprised that a lots of time have passed, causing their heartbeat to multiply, causing their anxiety to multiply. They at time feel like that we have lost. We cannot complete this paper. Sam, this is commonly happens. This was case with me. My legs literally used to shiver. My heartbeat before exam was very high. But when I observe that it is not about my efforts, it's not about my revisions, it's just about anxiety. Yes, Jaya, scrap papers are part of the solution, like part of the software. The software globally is same. Zayan, good. If the contract price was higher than the replacement cost, then this was not an onerous contract, right? This was not an onerous contract. We wouldn't have booked the loss. Fair. So please keep your mind working on the day of exam. Do not anxiety take you over. Keep yourself relaxed. This is the main problem. But people think that we must write everything immediately. Keep this machine in control. If this machine is not within the control, your hands cannot work. Your heart will not be supporting you. Don't lose hope till the last minute. We have to pocket 50 marks first. Remember, don't start attempting challenging questions first. Never start attempting challenging question first. Always pocket 50 marks. Jaya, don't you worry. ACCA has provided good support. Practice on ACCA's platform. You'll find it better. Yes, I can assume this is first time, and everything first time is very difficult to absorb. Zayan, remote exams are difficult because while attempting your answer, you are at the same time worried about the power backup in Pakistan. You are at the same time worried about the internet connection that might be lost. You are also worried about the battery of the laptop that might drain. So because both are your headaches, the paper and the machine, these both are your responsibilities. In center based, that is all responsibility of the British Council or any exam conducting body. If your PC stops working, if your connection fails, you'll immediately report it and you'll get extra time for it. Even if you don't get your machine broken, if there is no such problem, but you will keep on thinking that may God keep everything smooth. My machine must not stop working. Avinash, that would probably be due to RAM. We'll discuss on it. You can drop me a WhatsApp message. I'll tell you. If your machine is latest, this must not fail the test. Sadal, anyone? Yes, yes, Dhyan. The exam will exactly be same as center based and remote. There will be no different questions. The questions you will face will definitely be same. No, it's not mango. It's Thadal, Savina. You can understand this. This is something different. A very nice drink. Hmm. You must be missing mangoes. Very famous from here in Pakistan. Okay, so moving forward to next part, Exhibit 2. I would appreciate if you, Ola, it's not that larger bank, question bank. For MCQs, providing a larger question bank is possible, but for constructive response questions, ACCA cannot provide a huge question bank. So plus or minus, every student gets the same question. Believe me. Yes, Akib. Chaunsa, but Sindri is at the top. Exhibit 2. A government loan of 50. Yes, Sabina. These are obviously very delicious. Sindri mangoes are very delicious. A government loan of $50 million was received on 1st April 2020. We are talking about a year back. The coupon rate was 6% per annum, payable annually, and principal is repayable on 31st March 2025. What is the maturity period of the loan? 5 years. The loan was granted, Dut Sarmat, on certain conditions. You can note this, which had all been made at 1st April 2020. You do remember that if a government provides us any grant, that grant can be conditional or that can be unconditional. This one is conditional, but we have satisfied all the conditions. The loan was not designated as measured at FETPL on initial recognition. IFRS 9 gives the choice that a company can designate the loan at FETPL. No, Hassan, not in this case. If the loan is received particularly for capital expenditure, then we get an option to either capitalize or deduct from the cost of the asset or show it as an unearned income. Only in case if that grant is capital grant. This one is loan, subsidized loan. This cannot be dealt with as a capital grant. Fair. The loan was not designated at FETPL. The prevailing market interest rate on 1st April 2020 was 11%. When the interest rate in market was 11%, but the government granted you this at 6%. This is subsidized. Amna, Hassan said that we can capitalize the grant and amortize it over the grant period or useful life of the asset, or this can be subtracted from the actual price of the asset obtained using the loan. So I'm telling you, I was telling Hassan actually that this has not been obtained particularly for any asset acquisition. Sakib, nowhere in the question is mentioned that we are supposed to purchase any asset. If we were supposed to not purchase, to construct any asset, if any loan is obtained to purchase an asset, IAS 23 does not apply. IAS 23 only applies when an asset is constructed using the loan proceeds. Remember, that is a qualifying asset. Good, yes, qualifying asset only. Very good. Fair. So here, nothing to do with an asset. It is just a loan. But the conditions, whatever they were, you have already met. The prevailing market rate was 11%. The amount received was credited to loan and interest paid for the year has been charged to profit or loss. Do you agree with this? Debiting cash $50 million, crediting loan $50 million, and charging coupon as finance cost. Do you agree with the treatment they have done in the absence of net stock? Yes, IFRS 9 applies. So here two standards are applicable, IFRS 9 and IAS 20. Jaya, let's solve it. So it's question number 2 and part A and second part of part A. No, coupon shouldn't be debited from loan. No, never. Coupon should be debited to finance cost, but it is not coupon that we charge to profit or loss. It is always effective rate that we charge to profit or loss. Amna, do you remember that IFRS 9 provides a fair value option, allows a fair value option where even a financial liability is supposed to be measured at amortized cost, the company can still choose the fair value option, irrevocable election. Financial liabilities and financial assets can be measured at FETPL at the option of the company. Yes, to reduce the accounting mismatch. Well highlighted. The exact terminology used by IFRS 9 to reduce the accounting mismatch or inconsistency. Very nice, Ayan. True, true, true. Okay, so loan obtained is a financial liability which, as per IFRS 9, must be recorded initially at what? Fair value less transaction cost except FETPL. Amna, that FET-OCI option is only for equity instruments. There are 3 options in total. For financial assets debt instruments, it is fair value option. For financial liabilities, it is fair value option. For financial asset equity instruments, it is OCI option. So fair value option, OCI option. And FET-OCI option is only applicable for equity instruments. So loan must be measured at fair value by discounting contractual cash flows at market interest rate. Yes, financial liability can only be recorded at amortized cost or FETPL. Sam, we have got 3 options to exercise, possibly as per IFRS 9. Company can choose fair value option for debt instruments financial assets. If we have purchased loan notes, bonds, debentures, the company can choose to report the debt instrument at FETPL. That is the choice of the company. Number two, if we acquire a financial liability, the financial liability is most commonly reported at amortized cost. But if the company wants to keep it at fair value to remove accounting inconsistency or to mitigate the accounting mismatch, company can also exercise fair value option for liabilities. And for equity instruments, if we purchase shares of another company, that is always supposed to be recorded at fair value. There is no cost exception. There is no amortized cost available, model available. But the changes can be taken to other comprehensive income. Purists, if you are given the fair value, if you are given the fair value of financial asset or financial liability, you must not discount the cash flows because the fair value has already been provided in the question. Zayan, accounting mismatch. Assume you have got a foreign currency loan and you have got a foreign currency investment, right? Earlier, you had the financial liability acquired in foreign currency whose changes are being reported to profit or loss. After certain years, when you had sufficient cash available, but you were not able to repay the loan early as per the covenants or as per the clauses, so you preferred to hedge it and you bought invested in foreign currency bonds in order to mitigate the risk. The loss generated by liability will be compensated by the gain generated by the asset and vice versa. But if we carry financial liability at fair value and financial asset at amortized cost, the problem will not be solved. Similarly, if we carry financial assets at fair value and financial liability at amortized cost, the profit or loss would not eliminate the differences. So we can opt for the fair value option to remove the accounting mismatch. Nelly, if I have been operating in dollars and I obtained a loan in pounds, that is my liability. And that liability as per IAS 21, since it's a financial liability, is being remeasured at fair value. All the gains and losses are being charged to profit or loss. After certain years, the company has sufficient cash available, but that financial liability cannot be satisfied due to some covenants or possibly due to some clauses. So company or management rather decides to mitigate the risk by investing in foreign currency bonds in pounds. If the financial liability is treated at fair value and financial asset is treated at amortized cost, the profit or loss will not net off the gains and losses. There, IFRS 9 gives you an option that you can carry financial assets at fair value, even if these are not held for trading, even if they are satisfying the cash flow characteristics test model, even if they are satisfying your business model test. But company, if wishes, can report the asset at FETPL to remove the accounting mismatch. Moving forward, So someone's question was when to discount. Purus, are you clear on this? That if the fair value is provided, you are not supposed to discount it. But if you're not provided with the fair value, you must calculate the fair value by discounting it. So time, then is contractual cash flows. Let's apply factors, and there is the PV. How many number of years are we supposed to pay interest for? I cannot write 1 minus 5 in Excel. 5 years. And how much amount are you supposed to pay? 6% of 50 million. Coupon, right? What happened? And how much principal am I supposed to pay back? $50 million. Fair. How much is rate prevailing in the market? 11%. Assuming it as an email. Fair. See, how would you calculate the annuity factor? 1 minus 1 plus I power minus n. Put it in brackets. 1 minus 1 plus I power minus n whole divided by I. Good, Hamza. And how do we calculate the discount factor? 1 divided by 1 plus I power n. Cash flows multiplied by annuity factor, principal repayment multiplied by discount factor. Zayan, I have already included 3 million above as a 5th year. If I keep it as 4 years, right, then you can include this 53 million here. Glory, these 3 million are per annum. Whenever the cash flow is constant, we are supposed to apply the annuity factor. Easy. If the cash flow is one-off, then the discount factor is used. So how much is the fair value of financial liability? I can apply a shortcut here. Rounding up. Since I'll not be getting borders to apply, so I'm bolding it. Explaining further, North Limited must record the financial liability initially at 40.76 million dollars and amortize it over 5 years maturity period. You can use both, Sam. You can say at present value, you can say at fair value, because you were not provided with the fair value, so we have calculated the fair value by discounting it. This is what you have learned in paper F9 FM, if you have attempted it. How do we calculate the bond value? So over 5-year maturity period, using effective interest of 11% per annum. Yes. So the transaction should have been debit financial liability, credit cash. This has been treated, but let's calculate the interest first, and then we'll be passing the double entries. How much would be the brought down balance? Hamza, the difference is government grant. The difference is government grant. Government has paid you 50 million for 40.7 million liability. The difference has government's grant. Okay, and this is 11%. How much was coupon? 3 million. Opening plus interest minus CD. Okay, so adjusting it. Has company debited cash earlier already? Yes, but the company has credited financial liability by 50 million, which should not be 50 million actually. The financial liability should have been recorded at 40.76 million. That is always, Sam, interest is always paid in arrears. That is a presumption. Interest is never paid in advance. Interest, I'm talking about interest. Sure, Hamza, I'm just for your help. What has been recorded? Debit cash or bank by 50 million. And they have credited financial liability by 50 million. At year end, debit finance cost of coupon 3 million, credit cash or bank by 3 million. This is what they have done. Fair? We need not to show this. I'm just showing for your help so that you can understand what adjusting entries are we making. Yes, that is wrong. So they have recorded this way, Sam, and this is wrong. What should have been recorded? Debit cash or bank by 50 million. Yes, anyone? Credit? No, Sam, you have received the entire amount. Credit liability by 40,760. You're not supposed to debit cash by that. And credit government grant by the difference. And at year end, what should the entry have been? No, Sakib, you could have shown this as a deferred income, but the question is specifying that all conditions have been satisfied. if you were supposed to, Amna, because this liability was actually worth 40.76 million, but government has given you 50 million. Hamza, government grant will be treated as an income immediately because conditions have already been met. Sam, okay, you're talking about the finance cost. So finance cost should have been 4484. Credit cash or bank should have been by 3, and credit financial liability should have been by the difference. Fair? So I have merely shown this for your guidance. We are directly supposed to pass the adjusting entries. We are applying Ola. It says conditions associated with the subsidized loan has already been yes Hamza, only the adjusting entry would suffice. It is just your help. I'm showing this all calculations. Whatever I have bolded in borders or highlighted in borders is not supposed to be done in the exam question. True. Finance cost goes to profit or loss because this is not borrowing cost. Hassan, this would have been, please note here, it says the loan was granted on certain conditions which had all been made on 1st April. Since you have already made the conditions, you are not supposed to amortize it. As per matching concept, we normally amortize it over the loan period when the conditions are supposed to be made over the time. Amna, subsidized means below market. It's very prominent that government has awarded us the loan at 6%, and how much is the interest rate prevailing in the market? 11%. This could have been covered by charging a premium. If government would have said, I am giving you 50 million today and you will be giving a premium after 5 years, then this wouldn't have been a subsidized loan even. But if government is giving you 50 million and getting back 50 million, the loss borne of 5% every year by the government is government grant. Hassan, if the conditions of the grant were supposed to be made by March 25, 2025, then matching concept would have been disturbed. But since you have satisfied all the conditions immediately, this is being treated as immediate income, is not breaching of matching concept. Remember, understanding, because conditions have already been satisfied. Yes, Amna, coupon rate and effective interest are different. Let me show you how does this happen. Say, if government had granted you 50 million, this would have charged 11% every year, and minus you would have paid government 3,000 only. So after 1 year, this would have been 52,500. After second year, this would have been 55,275. So this premium would have covered for the loss. So this was not a benefit. But since government is getting 50 million back, all are true. There is no point of applying a straight line here because conditions have already been satisfied. Move forward. Quickly, what would the adjusting entry be? Debit, financial liability initially. See, at what value have you recorded the financial liability? 50 million. But at year end, at what value should the loan be carried at? 42,244. Ola, that is fine. Zayan, that is fine. There are two possible entries. I'm making directly. I'll show your calculations as well. Debit financial liability, debit finance cost. Finance cost must be charged by the difference. It is 4,004 minus 3,000. Right? Credit, profit or loss as government grant. Fine. This is directly adjustment at year end. I can see lots of emoticons. No, sorry, I moved up. No. Why am I seeing the previous responses? They're all mixed. Okay. So the finance cost should be 1516. Why is that so? The finance cost should have been 4484 and the coupon is 3000. This is fine. Why should the finance cost be 1516? Hamza. Yes, Hamza. Okay, you're correct now. 3000 recorded and should be 1484. Yes, this is 1484 now. Who was lost? Yes, Hassan. Want to ask something? I can wait for you. Okay, let's move to next exhibit. No. Hamza, the effective interest is 4484, right? The effective interest. Okay, Hassan, that's easy. I'm explaining you immediately. Let's divide this entry. This is the compounded year end. I'm dividing this entry. Let's do adjustment at initial recognition first, right? Zayan, that would have been very easy if the fair value of the transaction cost was given, then the present value was not supposed to be calculated. Hassan, at what value has the liability been recorded? I'm talking about 1st April, the day when the loan was obtained. 50,000. Good, Hamza. And at what value should the liability have been recorded? At initial measurement. 40.7. Sam, perfect. So let's observe a difference. We should debit financial liability as it's recorded at 50,000 minus, and it should be recorded at 40,760. So I've debited financial liability by 9240, right? And credited it to profit or loss as government grant by the same amount. Okay so far? Next, adjustment at year end. How much finance cost should have been recorded? The effective one is 4484. Good. But we will, in the end, we'll immediately perform it. That is part of requirement. We'll immediately show all the impact. Akis is asking, we are not showing the total assets, total liabilities, and ratios. We will immediately perform it. Yes, and deduct already recorded. How much liability has they already recorded? The coupon one? 3,000. Okay. Here we go, 3,000. So finance cost should have been debited by 1484, right? And this should have been credited where? Yes, this should have been credited where? Amortization always increases the financial liability. Fair. Now you can observe carrying value of financial liability. You could see we debited financial liability by this 9450, 9420, sorry, 9240, and we credited liability by 1484. Sure, Zayan. I'm coming over there. So you have debited financial liability by 9240 and you have credited liability by 1484. What would the net impact on financial liability be? Bingo, 7756. This is what I did directly. Fair? So both are possible. If you are getting confused with a direct entry, then it is better to be safe. Can I remove this? In fact, I'm highlighting it, bordering it so that you can keep it safe. Sam, we have practiced a lot. When I was a student, these things were obviously beyond my understanding, but we have been practicing it since 2010, I told. Though I don't seem that old. I did qualify my ACCA in first attempt, yes. Uh, who was asking for any defector? Zayan. Zayan. Okay, shall I move forward? Sakib, I am basically in managing position. I'm managing director of an academy. I'm running my own college here, making money, yes. And but I spend lots of time in teaching. I love teaching. Yes, thank you. Okay, next part. Exhibit 3, quickly please. On 1st October 2020, North Limited entered into a contract for sale of a plant to Catlin Stock. Yes, Zayan. No. I simply teach FR, financial reporting, FM, financial management, and SBR and APM. Rest, I'm spending my time on ICMAP. I teach strategic papers of ICMAP and BSF at Zabest. Okay. Yes, I own Alumni Academies, Hyderabad campus. Yes, we do cover all subjects till AAA. Yes, we do cover. We have got the faculty. On 1st October 2020, North Limited entered into a contract for sale of a plant to Catlin Stock Limited for $100 million when the carrying value and remaining useful life of the plant was $80 million and 10 years respectively. How much was the carrying value of the plant? 80 million. How much did you sell it for? 100 million. How much is the gain on disposal? 20 million. Though the plant is still in use of North Limited, it was immediately derecognized from the books. Could be correct if we have lost the control, but OLAT is not lease back, it is buyback. If this was lease back, then IFRS 16 would have provided guidance. Under the terms of agreement, North Limited has the option to repurchase the plant by 30th September 2022. When did we sell it? 1st October 2020. When can we buy it back? By end of September. How long? 2 years. Yes, Hamza, this would be treated as per IFRS 9 in its entirety at $123.21 million. So we have obtained $100 million and we are having an option to repurchase the asset at a fixed value. Whenever the repurchase value is fixed, it is not a sale. Because the risk and rewards have not been transferred. Ola, if we have sold an asset and we can buy at then market value, that means I have transferred the risk and reward. But if I have sold the plant for $100 million, say after 2 years, its value rises to $140 million. Who will enjoy the gain? I, not you. Because you are supposed to sell it back to me at 123.21. And who is directing the use of this asset? Because asset is in my custody, I am still using it. So I am directing the use of the asset. I have not transferred the control, of course. Let's move. Do you believe this asset should be derecognized? Yes, the finance cost goes to the profit loss. It is not a sale in substance, right? But as per the requirements of SBR, you will have to write. You cannot directly perform calculations. I have involved lots of calculations just because to keep it interesting so that you can participate with me. So North Limited has sold the asset to Catlin. Maybe title has been transferred with it. But as North Limited continues to use the asset and direct the use of the asset, plus has option to repurchase the asset at a fixed value. Yes, Tawfiq, we have borrowed 100 million now, and in future terms we'll be paying 123.21. True. So at fixed value clearly shows that substance or the control has been retained. This transaction in substance is not a sale, but yes, Zayan, we would have considered the significant financing component if this was a sale. IFRS 15 is not applicable here, and IFRS 16 is not applicable here because it is not sale and leaseback, and it is not sale either. Like if we were supposed to calculate the interest rate, although it is given in the question, how much is future value? 123.21 divided by how much is present value? 100. Applying growth formula over 2 years. Minus 1. This is 11% per annum. Fair? We can calculate interest rate, right? How? Future value divided by present value raised to 1 divided by n. If you could remember. Calculation not required, just for your understanding. Okay. So yes, where this is for interest rate. Financial liability must be recorded at fair value, and asset must not be derecognized. Liability is subsequently amortized to reflect effective interest, and plant must be depreciated as regular. What would be treatment of financial liability? Let's see how much has been the duration. What is the year end? 31st March. Right? A year end is 31st March. And when we have obtained the loan, first October. No, Zayan, IFRS 5 does not apply here. Remember, IFRS 5 only applies to assets that are still held for sale. Assets that have been sold does not fall under IFRS 5. Getting? If the company has decided to sell an asset but hadn't sold it yet, then IFRS 5 can talk. But if the company has decided and sold it before the year end, IFRS 5 cannot interrupt. Yes, good, Anna. The depreciation will continue on 80 million. How long has the transaction? How before long the transaction took place? It's 1st October. So October, November, December, January, February, March. True? 6 months. Liability. At what value is liability supposed to be recorded? 100 million. Finance cost. How much is effective interest? Easy? 11%. Good. But we have just spent 6 months till the loan has been obtained. We are not supposed to pay any coupon because we'll be paying the compounded interest altogether. So the carry down balance would be 105550. Fair? Yes, Hamza, I missed it earlier, then rectified. So he'll say finance cost of 5.5 million must be charged to profit or loss as 6 months interest. Yes, Zayan. Did you notice this? We have obtained loan from 1st October and we are closing statements at 31st March 21. Correct, Amna. No coupon because we are not supposed to pay any coupon. We'll be paying entire compounded interest after 2 years. Yes. Okay. Plant must stay in SOFP of North Limited at its carrying value and depreciated for 6 months derecognized period. Carrying value of the plant was how much? 80 million, right? And life of plant at transaction was 10 years. I cannot years with this because the formula won't work. Depreciation for 6 months. Carrying value divided by life multiplied by 6 divided by 12. Fair? Easy deal? If things are understandable for you and easily explained, then double entry is not necessary. But if you wish to pass the double entries, then we can debit plant back. We can record plant directly at what value? 80 minus depreciation. Yes. Okay, yes, well highlighted, Hamza. I must write it as well. Therefore, the gain of $20 million realized to profit or loss must also be revised. Thank you. Okay, so debit plant at what value? 80 minus depreciation of 4. Debit depreciation charge 400,000. Debit finance cost for the year 5,500. Credit what? Financial liability. At what value will the financial liability be recorded at year end? 105 500. And crediting, sorry, debiting, my mistake. The gain on disposal. Gain on disposal has been recorded as 20 million. Let's see if entry is balanced. All debits minus credit. So entry is balanced. Shall we move? Okay till now? Uh, cattle go. If there would have been mentioned that the company can purchase the asset back at their fair value, then this would have been treated as a lease because asset would have been derecognized. Fair? The question arose here is, if the question states that North Limited can repurchase the asset at its fair value at the date of repurchase, then the duration gain or losses will be lying with the Catalan Limited. In that case, North Limited will derecognize the asset, will not record the liability, will charge the gain or loss, and for the duration 2 years, let's say, a lease liability and right of use asset would have been recorded, but asset would have been derecognized. That would have been similar to sale and lease back. Yes, sure, Amna. Amna is asking me to note down that what would be what would the treatment be if North Limited was supposed to purchase the asset back after 2 years at its fair value rather than at a determined fixed value. North Limited should have derecognized the machine or plant as the gains or losses from movements in fair value lie with Catalan Limited and treated it as a leased right of use asset as per IFRS 16. If the sale if the buyback option was highly probable, that would have been considered as guaranteed residual value, and a corresponding lease liability should also have been recorded. Fair, Amna? Because Amna, I have sold an asset for 100 million and can buy back at that market value. Let's assume the market value raises to $150 million. Who will be earning that $50 million during that two years period? Definitely the Cadling will be enjoying the benefit, right? So that would have been a sale. Next. So here is requirement B. Let's complete requirement A now. Requirement A asks you to show the impacts on what? Relevant assets, liabilities, and total assets. Sorry. And liabilities to asset ratio. Let's read this last point. Exhibit 4. This is pure theoretical, and you can structure your answer yourself. We'll just highlight some areas that are supposed to be written. This exhibit 4. On receiving the revised financial statements, the chief executive officer called Ned Stark, Robert Baratheon, and briefed him in the following manner. Since the position of CFO is vacant, I intend you to promote as CFO. North Limited has been through a rough year and has some disappointing results, but a reasonable profit needs to be reported for mutual benefit of all stakeholders. Moreover, the financial statements would also be scrutinized by the bank to ensure that loan covenants are met, which includes maintaining total assets of 1.5 times the total liabilities. Therefore, I want you to confirm the draft financial statements without making any adjustment. What wording are they using? I want you to confirm, right? The draft financial statements without making any adjustment for the presentation before the board and submission to the bank. So they are supposed to be submitted to the board. There would be a threat as well. And before the bank, right? Now, what ratio are we supposed to? Zayan, Ned Stark is not an auditor. You are suggesting that this should be submitted as qualified, right? Not unqualified. Qualified, you mean, I believe. But of course, we are not the auditor. Here we are acting as the financial manager, right? Financial manager. Shouldn't we follow what CEO is asking us? We'll be getting position of CFO, of course. And in case we deny what CEO is asking us to do, we might lose a job. B, eat fries. Read yourself. Fries, anyone? Good. So identify and discuss. Zayan, were you having the snacks? No, my wife brings it. She loves me. Okay. Salman, we are supposed to identify the traits. Self-interest, very nice. Intimidation, very nice. Hola, perfect. Self-interest and intimidation, good. So identify and discuss. Yes, Ansa. I don't take breaks. Uh, you'll identify. You have identified two traits here. Traits here: self-interest and intimidation. And discuss. Why do you think there is self-interest threat? Why do you think there is an intimidation threat? You have identified, fine. You'll discuss that why in this scenario do you think these are the threats and ethical issues that NetStark needs to consider from CEO's discussions. Fair? Next. And what actions he should take as a consequence. Fair, Mojisola? There is an advocacy threat, but yes, because we are acting as a financial manager. Yes, true, true. So you'll identify the threats, you'll discuss the threats, and the actions you will suggest deemed necessary for the NetStark, right? There you'll mention that NetStark is an ACCA member and must not compromise his integrity. No, Zayan, coming over that now. Fair. So will you structure your answer yourself for this B part? You will specify examiner that what are the responsibilities of an ACCA member. We are not sure whether the CEO is also member of any professional body, but if he is, then we must discuss and remind the CEO about his responsibilities as a professional accountant. We should discuss the case with the CEO and inform about the consequences. Later on, if the table talks are not working, then you might consider further actions. Whistleblowing, reporting the board, fair, and in extreme case, you know that should stay away from this. Yes, good others. But resignation is the last option. Or we can consult with ACCA or any legal advisor. These are the common answers. We always put the same answers for these similar questions, right? So the first option we'll be discussing that this should be very nice, Dayan. This should be discussed with the audit committee. Good. Good, Amna. So you people are performing well here, I believe. So this should be discussed with CEO first. You should have table talks, and then inform him that this should be misleading. This would be very misleading, and ever things are disclosed in future will be facing dire consequences. Then we will consider about informing the audit committee, board of directors. Okay, Ola, we can. So let's complete this ratios part first. Okay, how much assets are we currently showing as per question? Where assets are 1420, right, and liabilities are 925. So ratio is liabilities to asset, right? Or was it assets to liabilities? Total assets at 1.5 times the liability. Sorry, so I have written it wrong here. This is assets to liabilities. Yes, yes, of course, Zayan. I'm showing what has been reported and we'll be showing impacts on. So this is assets over liabilities. Seems maintained if we round it up. And how much profit have we reported so far? This is not required though, just showing the double impacts. It's $125 million. Impacts of Exhibit 1. We were supposed to show loss of 8.4 million, right? Impairment loss of 8.4 million and onerous loss of 1.6 million. NRV profit was being reduced by 1.8 million and assets were reducing by the same, right? Next, onerous contract. Profit was suffering by 1.6. Sorry, my mistake. This is 8.4. Yes, yes. My mistake, Amna. And onerous contract was, I'm poor at remembering numbers. It's 1.6. So your profit would fall by 1.6 and your liabilities would increase by 1.6. Easy? Does it? No, Ola. This does not include this. This only increase 1.2, 1.2 and 6. No, Sam, it is not including the onerous contract. Hamza, recording will be available by tomorrow afternoon. Okay, so done with exhibit 1's impact. Next, this was government grant, right? So this government grant was putting net impacts of financial liability was reducing by 9240 and profit was increasing by 9240 if we consider the net impact. Purus, we have shown it, I believe. See this? Liabilities, I have increased it by 1.6 million. Was there anything else? There was a write down to NRV that has report impacted our profit and reduced assets. And I have included this these liabilities in, okay, due to onerous contract. Next, we were up to exhibit 2. Fair. So the net impact on financial liabilities was 7756. These were reducing by 7756. Exhibit 2, this was because of government grant. A profit was increasing by 9240, so 9.24 million, and financial liability okay, 1484. Good. Finance cost, yes, Hamza, good idea. We can put the net impact, and finance cost is 1484, 1.48, and this is in minus. Fine. And net assets on liabilities was 7756. Plus liabilities were minus, reducing 7756. Right? Was there anything else? No? And exhibit 3. The final entry that we made was this. Assets are increasing. Zayan, simply put minus in before. Like now, you can see this. If I select these tables with the numbers, we have got upper like comma separator. Easy. If I'm keeping it 2 decimal places, you are simply supposed to report it as minus. Yes, this is available in a spreadsheet. This is not required, Sakib. This is not required, but this is very satisfying. When you see negative figures as brackets, this is satisfying. Exhibit 3. So the impact was plant by 76,000. Plant increased by 76 million. Liability increased by 105.5. Depreciation, finance cost and gain debited. Depreciation minus finance cost minus gain. So minus minus plus. In fact, my mistake was that these amounts are in thousand figures. So it's safe to do like this. 29.5. Good. Let's sum it up. Common problem with the students not familiar with Excel, they forget to put equal before applying the formula. Hola, why this isn't for you. Okay, done with this. The profit reduces to 93.26 million. And let's see the final impact. Assets divided by liabilities. The ratio is falling to 1.45. got everything? Let me know if you have got any confusions, or I'll wind it up shortly. And my food is wetting here. Rolls anyone? Okay, let me know if any of you is having any confusion with this. What? This would be considered as material, fine. Almost, Zayan. But this sin is worth doing, I believe. You shouldn't be that serious. Yes, food from outside. Be ethical, right? Alright, this is very yummy, right? Actually yummy. Yes, Zayan. You can mention that there's a slight adjustment, but the professional accountant must always be ethical, because any such actions will discredit the profession and may face severe charges by professional body. You personally might believe that the sin is worth doing, but you can never say that in front of examiner. You'll be penalized. uh Somi, maybe I missed it. If you have texted me during this webinar, then I would have missed it, because during this webinar I cannot use my phone. If you have dropped me a message, I'll add you. Oh, hola. Sorry. So you're not able to eat any food from outside, right? Be careful, and wish you good luck. Will you be going to attempt the exam in this condition? Early months, right? Sure, Sakib. If it's not too long, you can go to washroom. Yes, Sakib. It's over. So today we are ending it on time. I'll be sharing the solutions with you, and tomorrow will be our last day. I have shared question number 3 with you. That is also that I've constructed from other different sources. Amna, I would appreciate if you could answer it yourself and share it with me, because the answers with ethics are quite similar. These do not vary much with situation to situation. Yes, Ola, wish you very good luck. Be brave. This is very difficult time. Like I can assume this, but wish you good luck. All right then. So ending the session for today. My food is wetting. Would have offered you, but this is benefit of remote. Sakib, aren't you in the group? Not actually. I must eat. I must not wait. Hmm. Now I'm enjoying it. Okay, bye bye. Yes, Ola, you can share on WhatsApp your answers on ethical area. Try to attempt it at least, because when you start practicing it, then you'll be able to answer it. Try it at least. Take care. Bye bye, everyone. Thank you so much.